Hello and welcome to our AIM Summit webinar on the evolution of MENA private credit. This session is sponsored by Abu Dhabi Catalyst Partners and Ruya Partners. I'm your moderator, Zachary Sefaradi. I'm the CEO and founder of Dalma Capital. If you are joining us after the session on YouTube, please like and subscribe to this YouTube channel. And if you'd like to be part of the live sessions, be part of the Q&A, be sure to go to aimsummit.com and sign up for our upcoming webinars. Introducing our webinar partners today. Abu Dhabi Catalyst Partners. ADCP is a joint venture between Mubadala Investment Company based in Abu Dhabi and Falcon Edge Capital. ADCP was established in April 2019 with committed capital of $1 billion. ADCP has a dual mandate to achieve financial returns whilst also contributing to the overall development of the Abu Dhabi global market, or ADGM. They seek to partner with top-tier investment firms and industry-leading businesses who would benefit from the developing and meaningful sustainable presence in ADGM. Also with us is Ruya Partners. Ruya Partners is the region's first partner-owned private credit firm, providing flexible capital to mid-market companies in the developing world. Joining us from each of those organizations, we have James Munce, who is the CEO of Abu Dhabi Catalyst Partners. We have Mirza Beg, who's the founding partner at Ruya Partners. And we also have with us Maaz, Sheikh, who's the CEO and co-founder of STARZPLAY. So I wanted to start off the discussion, Mirza, with you asking about, with so many well-funded banks in the region, why is it that SMEs aren't able to get the funding that they need? What is the solution that Ruya, or the problem that Ruya Partners has been created to address?
Sure. Thanks. Thanks for having us on this session. So look, that's a multifaceted answer, and there are many reasons for that. So one of the things that banks tend to focus a lot on is looking at hard collateral, hard asset collateral. They like to lend against businesses which have physical plant, which has buildings, real estate, and whatnot, and these assets are available onshore. Meaning they're available in the same jurisdiction at which the banks have their license, so they can go through, enforcement processes on these assets if, God forbid, things don't go according to plan. A lot of the companies that we interact with tend to be cash flow rich companies, but asset light, for many different reasons, by virtue of the sector they're in, by virtue of the life cycle that they're in, by virtue of their desire to be an asset light model. And so those companies tend to get left out a little bit in terms of getting financed by banks. I think there's also a point to be made of looking at companies in different stages of their growth cycle. So there are certain companies, for example, which are growing at a very high rate of growth, but they still are yet to make profit. But there's a tremendous value in that business. There's tremendous equity value in the business. A lot of equity investment dollars may have flown into that company, to support that value. But when banks would look at that to them would be a credit risk that they would not be willing to take, that they would definitely not be wanting to take. Private credit, but because of the fact that they look at companies both on a historical basis and try to project out where this company is going, because of the fact that they combine a debt investment with an equity investment and also trying to figure out what's the value in the business and how well they're covered from a value standpoint, are able to provide better solutions for companies like this than what the traditional banking markets would. So I would say there are a number of situations. The two I mentioned specifically. Other situation would involve, for example, mergers and acquisitions, specific events where you have to, go into pro forma analysis of what a company would look like post an event. Those all require very deep analytical skills and the ability to have and analyze the equity of the business and both the debt of the business. And that skill set is much more readily available in a private credit provider than it's available in a bank, which is more designed to do financing transactions which are very standardized, which are very process oriented, and which are very repeatable in large volume.
Well, thank you for that introduction. And, I'm looking at the audience here and certainly excited to receive a Q&A from this audience as we go through this session, but I can recognize quite a few of the names. And it's great to see a balance. We have investors, but we also have several founders of some known companies in this region. And fortunately, again, on this session with us, we have both sides of that. So we have, of course, Ruya Partners, which is providing credit, but we have an investor in Ruya as well as one of their borrowers. So maybe I'd like to start with James Munce from Abu Dhabi Catalyst Partners. James, maybe you could tell us a little bit about why, as an investor, this asset class is attractive, where it fits into the investor's portfolio, and maybe we could again learn a little bit more about beyond the introduction I gave on Catalyst, why you think strategically it is important for the region.
Sure, and thank you for having us, Zach, and hosting as always. Let me take it from two angles, I suppose. Our mandate, why we like private credit, and where we think it fits in investors' portfolios. Our mandate is to invest in, support the growth of financial institutions and predominantly asset managers that have a real reason to operate out of the ADGM. And we're really looking for next generation alternatives. So that's where we think where a lot of the growth is going to come. And private credit couldn't be a better example of that. Mirza mentioned the banks a little bit. The way I view the bank lending market was historically, it was relationship driven. You knew your client, you knew where the risks were. There was typically collateral behind it. And it was a pretty standard transaction, but you got to know the person. You could lend on a relationship. That's gone completely now. Banks have become commoditized and they want form filling. And they're getting eaten on the other side by some of the AI businesses, the factor lending businesses who can apply a better level of technology to that standardized process. Where Ruya Partners can come in is from that relationship side, getting to know what the transaction is, what the business looks like, how to be flexible in the terms they offer, to get a better outcome for all parties. And as we think about growth in asset management and we think about strategies that are applicable, this lends itself perfectly to the ADGM. You're in an environment where yield is still important, where investors like to receive dividends still. We think you're in an environment where there's going to be a lot of M&A activity, where there could be some distressed assets. Again, all of that lends itself to expertise in structuring, in relationship building, coming up with solution-oriented products that aren't just bank commoditized products. In terms of where this sits with investors' portfolios, again, we think private credit's a great asset class for all those reasons. There's yield element, and so whether it's pension funds looking for stable, high yielding investments, it is a good place for it. But retail investors as well, what we've learned from the private banking market here, yield is important, dividends are important, but rates are low. Real estate's low, REITs are low. And so being able to come up with innovative solutions that might offer a more juiced return, but in a well-structured, well thought out, well risk managed portfolio is very, very attractive. And we're seeing that with Ruya so far, and with some of the other private managers and private credit managers we're looking to grow out of the ADGM. So for us, it's an important asset class. We want to participate all the way along the alternative fund managers private credit chain, from AI and factoring to venture investing, all the way through to the traditional private credit funds that Ruya look like.
Well, thank you for that overview. So now, understanding a little bit more about the investor side and where this fits in the portfolio, Maaz, I'd like to understand from your side, if you could maybe share a little bit about your organization, about STARZPLAY. Certainly, for those of us who know STARZPLAY's name in the region, it's I'm sure you have investors lining up out your door to invest in equity in the business. But you've decided to make a deal with Ruya in growing the business. Maybe you could share a little bit about what drove you to that decision, where this fits on your capital stack, what the other options are that you considered, and how you ultimately arrived at this deal, without getting into specifics about the deal itself, just maybe, again, relying on some of the information that's public and your experience in approaching it.
Sure. Thank you, Zach. STARZPLAY is a UAE-based, Abu Dhabi headquartered, homegrown startup, if you will, started about 6 years ago. And we're one of the leading streaming services in the region, operating in all of Middle East, North Africa, and Pakistan. In terms of funding, to date, we have done 3 rounds of equity funding. We've raised a total of about $125 million US dollars over a period of 5 years, with a combination of US, European, and regional investors, both financial and strategic. Lionsgate, who's one of the Hollywood studios, is one of our strategic investors in the venture. Especially after COVID, we saw a very, very strong year, and the interest in our industry, especially for streaming industry, became very strong, both from strategic investors as well as some of the bigger global PE firms. But at the same time, Zach, what we realized is that there's a lot more value to be created and a lot more shareholder value to be unlocked in the coming years, especially coming off of the behavior shift that we saw during COVID. And so as we looked for more growth capital, the management and our shareholders decided that perhaps, raising equity at this point wouldn't be the most efficient path to that liquidity that we needed, or that growth capital that we needed. So that's why we looked at alternative ideas, and we were at a company's life cycle where we were not cash flow positive, but we were headed to profitability, but we were not quite cash flow positive. So we weren't quite a fit for a traditional bank. And also, Mirza mentioned this, as we were dealing with some of the more traditional retail banks, we kept running into this mindset of, we're a tech company, so we don't have some of the real estate or physical manufacturing plants that other businesses have that can be used as collateral. And our business is also a virtual business, so it's difficult for a traditional bank to sort of grasp its technicalities. So all of this combined, we started to look at venture debt options in the region as well as globally, and we narrowed it down to one global bank operating out of London, and of course then we were having discussions with Ruya at the same time. So that's really it. I mean, when we discussed with Ruya, it felt a lot more a tailored product for us, if you will. We had, being a high growth business, we needed access to cash, but at the same time we had, certain preferences on how the deal ought to be structured, whether it's how the amounts are drawn down or what the amortization schedule looks like. So all those technicalities on how to structure the best deal for us, we found Ruya to be much more flexible. So combination of factors, and that's why we ended up working with Mirza and rest of the team at Ruya.
Great. Well, I'd like to come back to some of those factors and really hone in on factors outside of outside of cost of capital and how they affect your decision to go for private credit. But before we go back to that, I'd really like to get a better understanding, because again, you mentioned the challenges that you had with commercial banks, and at a high level, some of the difficulties that organizations like yourself have. I'd like to understand from Mirza, how do you differ in your analysis of the business versus how a commercial bank analyzes its business and its credit risk?
Yeah, so look, the processes are very, very different. I have also worked in a commercial bank in this region, so I've seen it firsthand. And so the commercial bank risk assessment process tends to be, tremendously historically driven. In a very, very broad brush, the process is that they look at the historical financial data of the company. It is usually sent to some outsourced location where they kind of like plug it into their standard risk model. They assign a certain sector to it, a standard based on the standard industry classification. They come up with some sort of an internal rating, and they effectively come up with some sort of a price for lending to that credit. And then based on that, the relationship manager has to go and get a certain number of revenues, to offset that cost of capital. That's a very, very simplistic approach. But the key point that I'm trying to make, it's that it's more backward looking, and it's more sort of like driven by what the company has already done. We tend to look at both. We tend to look at where the company has come from, but also where it's going. That's very, very important to us, because that's what allows us to do kind of like, create structures that straddle around what the company wants to achieve and what the company's business plan is. So for us, that free cash flow analysis, looking 4 or 5 years out, is absolutely critical. That analysis of valuing the business today and in the future is absolutely critical. Banks don't spend much time doing that. And that sort of like, allows us to create the flexibility in the lending structure that the borrowers want. Now, we are not, because we're not a bank, and because we don't have the same regulatory regime, we don't have to calculate any kind of risk-weighted assets or anything like that. Banks do have to do that. So depending on how they structure their deals, for example, if they give more years of amortization-free debt, that could potentially carry a higher risk weighting for that loan than would otherwise be the case. So they tend to, their infrastructure is such that they get stuck into more standardized solutions. We are not hampered by that. And none of the private credit providers get hampered by that. So we can create much better solutions for borrowers and for companies looking for capital.
So it sounds like flexibility is an important part of what you do. It's not just, again, cost and access, it's being flexible. So what are some of the key aspects of flexibility that you mentioned a few, but what are some other areas where you can be more flexible than other banks that aren't necessarily just credit or pricing driven?
Yeah, I think the typical ones, the usual suspects are your maturity, your amortization profile, your covenant package. These are kind of like the key typical things. And then there's various discussions around this actual situation at hand. So if it's an M&A situation, for example, we would spend the time trying to see if the company A is acquiring company B, what does A plus B look like? And so let's spend the time doing that work, getting our conviction around those cash flows. And then when we structure our debt and our covenants and the whole loan agreement, for that matter, and all the conditions around it, we're going to tailor it around what A plus B looks like. If you're in the bank, you only kind of get focused on A, and you're not really worried about what A plus B looks like. So it's more than just flexibility. I would say it's flexibility and tailoring around where the company is going. That's what we spend a lot of time trying to do.
So, Maaz, getting your perspective from STARZPLAY, having done a deal with Ruya. I mean, again, you mentioned the alternatives, going to banks, going for equity. Maybe you could share a little bit about other regional or global private credit firms and some of the key differentiators, the different approaches and terms that you saw and that ultimately led you to this deal and not others.
Sure. So in terms of overall cost of capital for us, when it came to venture debt, we looked at a couple of global options. So at a very high level, in terms of the cost of capital, I think Ruya was fairly competitive with one institution based in Silicon Valley and the other global bank based in London. I don't think either one of them really stood out in terms of the interest rate. They were all very close to each other. Where we felt Ruya was very different was in that all the factors that Mirza did mention, whether it was the amortization schedule, whether it was the maturity, certain covenant terms, those were very important to us. But ultimately also it was also about understanding the region. What we felt is that especially some of the Silicon Valley-based venture debt options we were looking at, they were almost penalizing us for being in what they considered a high risk market. And for us, this is our home. This is not high risk. It was normal, right? So it was just that understanding of the market. We felt that there was a certain, they were adding a certain risk factor for us being based where we're based, which is our home. So we didn't think that was necessarily fair. And then I think the last thing for us, the third thing for us, Zach, that stood out for us was also the fact that Ruya being based in ADGM, and we saw our relationship with Ruya as perhaps step one in building, in what is really a 4 or 5 step journey in building a more broader relationship with Abu Dhabi. So rather than build bridges to Silicon Valley, we thought let's build more relationships and let's build more bridges in the home that we live in and closer to home. So being part of that Abu Dhabi ecosystem in the long run was also an important factor for us.
Well, that's a perfect segue into my next question. So building those strategic links into Abu Dhabi, into some of the investors, into Ruya itself. Now, again, that dovetails over into James and what he's doing through Catalyst. Now, James, again, this for companies that are looking to build those strategic links into Abu Dhabi and work through these structures, there's obviously something on the other side of that, and the view that you have that this is a strategically important asset class for MENA evolution of the SME segment. So maybe you could expand a little bit more on why providing more financing options from Abu Dhabi, from the home market for SMEs that are growing here is an important part of that evolution.
Sure, and this is a really good example of our mandate coming to life in the right way. We're supporting a top tier fund manager who are growing in the ADGM, who are supporting a top tier SME growing in the region and can be part of that ecosystem in the right way. Someone told me recently that in Abu Dhabi and the UAE more broadly, 80% of SMEs have their outstanding contracts or their working capital, their outstanding invoices are owed by the government in one shape or another. And that the timing of receiving money is 140 days as opposed to a normal 80 to 90 day cycle. All of that lends itself to the fund management industry. How can the funds management industry drive disruption into some of these more traditional areas and help the SME market thrive? You're going to get a diversified economy and a growth away from hydrocarbons by supporting businesses like STARZPLAY. And we firmly believe that asset management is a key component to that, and the ADGM and growing asset managers in that ecosystem will drive that change. And it's our job to find those top tier asset managers, support their disruptive strategies, find other investors to come into them and help them support and grow the underlying economy so we get that diversification. And this is an absolute classic example of that. And we look across private credit, as I mentioned before, from that tech side. The ADGM is doing a huge amount in tech more broadly. We've got FinTech Abu Dhabi next week, which looks like it's going to be a great event. There's huge amounts of disruption going on in the tech space regarding private credit and factor invoicing and the way that you assess much more efficiency, debt, and the companies you're looking at through to the relationship building and the disruptive side of structuring newer products. And we just see it as a huge opportunity to support, bring institutional investors into. To Maaz's point, investors still view the region as risky. It's our job to show them that there are well-run institutional quality fund managers supporting well-run institutional quality SMEs who are growing in this region and growing in this market. And the more that we can demonstrably show that, the more inbound investment we get, which ultimately will be the success of the ADGM and diversifying the UAE economy, full stop, I suppose.
Brilliant. Well, I'm seeing a ton of questions pouring in from the audience, and I do want to pick some of those up as we continue our discussion. One of them ties into one of our discussion points very well. So Vanamali Mateti has asked a question about how the interest for private credit assets has evolved in the UAE and the broader GCC, which is more used to equity-like returns. And I'd like to expand on that with one of the speaking notes that we had slated for this discussion, which is why Western private credit firms have grown so substantially, whereas in this region, there have been a few non-starters. We haven't seen the same level of growth in private credit as we have abroad. So maybe Mirza, if you could expand on the kind of how the evolution of this asset class has been in the region, as well as some of those challenges and differences from the West.
Yeah, sure. So look, the asset class in this region is about 12, 13 years old. So it's fairly young, but it's not that much older than the institutionalization of private credit as an asset class. So, if you go back kind of like, 2000, 2002, yes, there used to be some funds who used to, institutional funds who were in the lending business. There were very few, even in Europe and the US. And the real boost came, from the global financial crisis onwards, with the higher regulatory requirements and whatnot. There was significant growth in this, and it basically became a formalized asset class. And it's now, the numbers now are, I think, of assets under management in private credit globally is, just a shade under $1 trillion now. Actually, it's probably past 900 billion now. So in the next few years, it'll be $1 trillion asset class. So that's a pretty major asset class that has happened in this region. You're absolutely right. There's been a more limited number of people who have played in this region, and I see two particular reasons for that. One is private equity sponsors. So this region doesn't have the same sort of, a whole bunch of private equity sponsors doing majority leverage buyout transactions. And that, if you go into Europe and the US, the private credit industry is symbiotically tied to the private equity industry in that sense. It finances a lot of private equity transaction, especially, a lot of these asset-like businesses, software deals and whatnot. And there's plenty of news stories out there of, deals getting done by Thoma Bravo, for example, in the US, which is a software specialist, and Ares coming in and doing, a big commitment to them, like $1 billion plus commitment to them. So that concept of PE sponsors available in this region doing majority owned leverage buyout deals, has not proliferated in this region. It has in the US, it has in Europe, but it didn't quite happen in this region. And so therefore the development of private credit by default was sort of like more limited in the sense it was more limited to things like growth capital, to things like recapitalizing balance sheets and whatnot. So that's one thing. I think the other thing is a skill set thing. The private credit industry requires a certain skill set. You need to be able to analyze debt. You need to know debt inside out. And you need to be able to analyze equity. So you need to figure out the equity story. You need to figure out the debt story. You need to be able to do documents, the debt documents, but you also need to understand how to do equity documents. There's not a lot of people in this market because of its size that possess that kind of skill set. So I think those are, I believe, are the two factors that are sort of like limited, the kind of development of private credit that you have seen in other markets. I think I would, as a third point, I would also add just, the size, the private market size of potential financing activities. Europe is is a big non-homogeneous marketplace. The US is a big homogeneous marketplace. When you kind of put things together, there's a lot to finance out there. A lot of different countries in the case of Europe, a lot of different companies in many different states in the case of US. Here, it's dominated by a few countries. It's dominated by UAE, it's dominated by Saudi. Then when you kind of like go beyond that, it starts to fall down a lot more comparatively to other places. How things have changed over time? Well, when folks started out pitching private credit as a product, some of the questions that were asked is, oh, what is mezzanine lending? What is private debt? What is private credit? Those questions are not asked anymore. People sort of like make up their mind that now these days that private credit is the viable source of capital that they should tap, and they engage in those discussions from the start. So that explanation, that education does not need to be given anymore to people about what is private debt, what is private credit, what is mezzanine debt. A lot of people now understand it. A lot of the advisor community now understands it. So those conversations are now easier to have with people because the education processes, a significant education process has happened over the last decade or so. Excuse me.
So another question from the audience. Hesham Kalantar, and again, apologies to audience members if I mispronounce your name. Do private credit providers like Ruya need any central bank licensing to lend, particularly if you're providing a secured facility and need to register or perfect that security under local laws? Maybe, again, you could also expand on this question to discuss, some of the flexibility that you have in terms of, the laws that you're using to for your contracts for enforcement. Some of the advantages of using laws like ADGM and their legal systems and processes. If you could expand on that from a licensing, regulatory, and legal perspective.
Yeah, so that's a good question. I think, look, I think the one clarification that is probably needed is that we're not strictly in the lending business per se. We are in the business of doing a private credit investment, which is a hybrid, typically, between mixing pieces of debt and pieces of equity together to create a flexible solution. So in these kind of solutions, we tend to put in place, quote unquote, in offshore jurisdictions. These would be ADGM, DIFC, BVI, Cayman, where we can basically structure our deals under English law. We don't do these transactions onshore. Therefore, we don't require an onshore lending license, and we're not in the business of taking deposits or providing credit to retail companies or anything like that. We are purely institutional. Only work with the M part of the SME, and so our investments are pretty much like private equity firms in this region. Are basically structured in as I mentioned, so like quote unquote offshore jurisdictions. So that's where our key, collateral packages are taken, basically the share pledges. Now, do we take onshore security? We do, absolutely. And where UAE laws allows us to take onshore security, registered onshore security, we go ahead and do that. Where we would not be allowed to do it, we typically work through a bank, a local onshore bank who tends to play the middle, kind of like the middle person security agent role, holding security on behalf of other lenders.
So, Maaz, I'd like to understand from your side, the perspective that you had in working with contracts and agreements and structures under, kind of a more flexible environment. Did you see that as an advantage from the borrower's perspective? How did that factor into or was it, a major factor in considering the different options available?
Yeah, certainly. Look, for example, for us, Zach, one of our key challenges in discussions with retail banks was lack of physical, hard assets. Whether it's inventory, whether it's a manufacturing plant or real estate, we that's not our business, and we didn't have any of that. So for us, not having some of those traditional collateral, if you will, was definitely a challenge for us. So having these discussions with Ruya was certainly very encouraging and a fresh change from the conversations we'd been having with traditional retail banks. Definitely, venture funding sources outside the region were available, and we had discussions with them. But Ruya was the only perhaps institution that we were speaking to actually spoke our language and understood what we were looking for. Being a high growth company, for us, the key was to have access to growth capital and have that flexibility on the terms that we needed when we needed access to the capital. So that's where I believe Ruya was most flexible with us.
James, from again, beyond the strategic aspect of supporting these types of funds, ultimately you are looking for returns, and many of the investors in this room are looking for returns. They're looking for asset classes that they understand, that they're comfortable with, that are giving them the right risk return balance. What would you say about this asset class from an investor's perspective, particularly for regional investors who have options to go into private credit funds in places where it's more established, like Europe and the US? What would you say are some of the advantages of looking at investing in the private credit market domestically?
I think across the private credit spectrum, there's different return profiles for every type of investor here. We, as you mentioned, are looking for returns. We have a pretty aggressive return target, and we see the opportunity and private credit more broadly here as a very attractive one. We also see it as a very attractive risk-adjusted investment. As Maaz mentioned, a lot of investors still see this region as risky. If you understand the region you're operating in, you understand the companies you're lending to, you can still get some of those higher returns, but in a much lower risk environment, we think. And so I think in the traditional private credit, there is the opportunity to really understand some of the M&A activity, some of the distressed activity, and get some really what we would class higher teen returns. If you're looking for just more safer yield above bank rates, there are products that are multi-thousand invoice factoring funds, working capital lines, shorter term financing across venture, across equity, across every sort of stage of a company's life, that have lower returns, in the 4 to 8% range, I suppose. And for us, that's why we think it's a really attractive asset class, because we're looking to grow a financial services ecosystem here. We want to offer to investors every spectrum of what they're looking for, whether it's solution-led or whether it's higher juiced yield. Some of the equity side of it is important as well. If you're really willing to understand, and as Mirza said, a lot of people don't really understand the full equity side, debt side, what mezzanine means, where in the cap structure you are. But if you're willing to partner with some of these firms, there's some really attractive outcomes for co-investing as well. So we really see it as a great opportunity and a great market. What I'd lastly say is, for investors, they can start to view the opportunities in this region, I think, through a safer lens. The ADGM has English common law in its entirety. We've got a pretty robust court system that's now been tried and tested. You can see contracts being written out of here and lending out of here that can be enforced. And people are getting more comfortable with that the more that happens here. A couple of the investments that we made early on were with larger brands in the private credit space. Them using SPVs here more commonly, getting more contracts out of here. And the more we can attract institutional, third-party, foreign capital in here to use the structures, the more it will resonate. And so we think for investors across the spectrum, whichever the return profile you're looking for, the structure you're looking for, there's options that are available, and those options are coming through more and more. The last bit I mentioned, I think we did a name series with Halo, one of our portfolio companies as well, on the structured product side of things. And again, ultimately, how do we get better outcomes for savers across the region, whether it's structured products or it's high juice co-invest equity debt tranched investments. We want something to be able to offer to everyone, and we think we're slowly getting that with the ecosystem that we're building out here.
Well, continuing on the discussion on the investor side, I'd like to go back to a question for Mirza from Lottie Tant, who's part of Mercer's Dubai team. They advise a number of institutional investors in the region on their investment strategy with a particular focus on private markets. So her question for Mr. Mirza is, how does Ruya Partners see the opportunity set within the UAE and GCC in regards to venture debt, mezzanine, senior lending, et cetera? And how does Ruya build balanced portfolio across underlying debt strategies?
Okay, wow, that's a pretty big question. So we would obviously hope to see this asset class continue to grow from where it is today. We think it will grow. We think it should grow. It's a very, very interesting piece of capital for people to tap into, for mid-market companies to tap into. I think if I address each one of those, in turn. So venture debt, I personally find it very, very interesting. That this region has sort of like gone through, I guess, call it a decade of tremendous investment in venture equity investments in this region. And so now what you're starting to see is the flourishing of some of those investments in the form of companies. I suppose not too dissimilar to STARZPLAY, but even I would say, earlier stage than STARZPLAY, where they have proved their business models. There's no proof of concept risk anymore. They have raised 1 or 2 rounds of capital, and they have raised enough dollars out there where a venture debt lender can then go in there and say, okay, there's enough value behind me, there's enough invested equity behind me that I could be a venture debt lender and help this company get non-dilutive capital, so that when it goes to the next equity round, it can raise that equity at a much, much better valuation, right? That concept is, in my mind, very undeveloped in this region. And I hope it develops more going forward, because in my mind, there's a white space need for that product to come to this market. If you compare venture debt to what's happened in the US market, venture debt typically is running at anywhere from 15 to 17% of the dollars invested in venture debt with respect to the total amount of venture dollars invested in the market, debt plus equity. So, we're probably not going to go to that metric right away, but there's plenty of room for that to grow. In terms of mezzanine, which is sort of like the more traditional private credit, again, look, I think this is, we have been talking about this product all throughout. And this gives a tremendous alternative for companies to raise flexible capital, to raise a capital that's, again, non-dilutive, that does not enter into a shareholders agreement with the founders. They have complete freedom to run their business as they please and raise capital. They obviously have to agree to the conditions and the covenants and whatnot, but those are all based on business plan they think they can meet. And in certain situations, I would say, but not in every situation. I don't think private credit works in every situation, but in a number of situations that are event-driven, that are growth-driven, that are driven for companies, trying to expand their business, doing capital expenditures, private credit makes a lot of sense, and I believe there'll be more and more opportunity going forward. And I make that comment in the context of this business cycle. We have had a business cycle because of COVID. A lot of businesses went down in the year 2020. In the year 2021, at least in the second half of it, we are starting to see things come back up. And when you kind of like look forward, with all the vaccination rates, and I hope this virus doesn't outmaneuver the vaccines. But assuming it doesn't, then the business cycle will have a lot of steam running forward. And so for people wanting to raise capital, private credit, mezzanine debt gives them a great alternative. And I believe this should be very bullish for people who are providers of private credit in this region. I think the last question was around senior debt. Look, senior debt is kind of like your core bank product. I think the banks are needed. They're never going to go away. They provide things which none of the private debt guys will be able to do. They provide undrawn credit lines. They provide revolving credit facilities. They provide invoice discounting. bank accounts, all those kinds of things. The private credit does not provide that. So I think eventually it's going to go to basically where the US and Europe went, where there will be a symbiotic relationship almost between the bank debt and the banks and the private credit providers. Both will find their place often in the same company together. A lot of companies we look at, for example, have bank credit lines on the working capital side, and we encourage them to have it because that's part and parcel of their growth. They have to have that working capital available to grow. We provide a different kind of capital, which is more so like medium-term capital for those same companies. But every time we look at those companies, we have to make sure that they have the room and the space to create an appropriate amount of working capital borrowing from the banks that they work with.
So just expanding on that, because we've been talking about a lot of the kind of profiles of companies, and part of Lottie's question was around building a diversified portfolio in the space. However, there are certain sectors that sound like asset light sectors, and particularly tech driven sectors that tend to be will be more of an affinity for your type of lending, and may not have access to the traditional banks credit. So question from actually a member of our team here at Dama Capital, Kuram Wahid, is the GCC more suitable for sector specific private credit, like tech private credit strategies? And he also wanted to understand if there are any regulatory changes that are needed to make it more popular in the GCC and in the region.
So to answer the first question, not necessarily, because there's plenty of situations that we look at. Specialist chemical companies, manufacturing companies, we look at those companies all the time. They have bank credit available to them. And the context in which we are having our conversation with them is in the context of giving them growth capital, expansion capital. They want to build a plant, they want to do an acquisition, whatever it may be, or they just want to recapitalize their balance sheet so that that they all have a certain number of bank relationships and they have certain credit limits within those banks. And instead of using those credit limits for kind of like permanent capital or medium-term capital, then they want us to come in, release those credit limits so that those credit limits are available to them for working capital. Right? Those are situations we look at all the time. So I would not say that private credit would get limited to certain sectors. Although I would say that if for certain sectors, private credit would make more sense to use as opposed to using the bank market. Sorry, Zach, what was the second part of the question?
Any regulatory changes on your wish list to make the sector?
I would love to see people making it easier to take collateral onshore to enable folks like private credit also to be able to provide credit more easily. I think I don't think it's a restricting factor, but I think it will certainly be an aiding factor going forward. We would love to be able to see if full ownership of onshore companies. I think the UAE certainly is moving in this direction already. So that was a very healthy change that we saw. But hopefully that will continue going forward. I would say, look, there's nothing sort of like restricting us from a regulatory standpoint. But if some of these changes are implemented, I think it will certainly help the financing landscape. It will certainly help these companies have more options for accessing capital.
So another question is really asking about advice for startups and for emerging companies that are raising capital. And Maaz, I'd maybe like to see if there's any general advice that you might give to companies that are considering private credit as a solution. What are the kind of deal sizes that they might be able to expect that are realistic? What how can they position themselves or make sure that they're right for being able to tap into capital from this market?
Sure. So it really depends on the life cycle of the company. Typically, the venture debt would make sense at a stage where you've done a couple of rounds of equity already, and you have an established product or an established service in the market, and you're trying to decide whether a third round or a fourth round of equity would make more sense, or would it be more efficient to raise private debt. That's typically the trade-off or the situation where venture debt or private debt would come in, is either typically after 2 rounds or 3 rounds of funding, equity funding, and then you're looking for your next growth phase, and you're trying to decide whether you do another round of equity or you go with venture debt. So in our case, we'd done 3 rounds of equity, and we were at that cusp where we were about to hit profitability, and we just come off of a very strong growth year thanks to COVID and the lockdowns. So we felt that the company's value was not being truly reflected in the valuation that we were getting. So it was better for us to go through another couple of years of growth and then go for that next round of equity. And in between, during this transitionary period, we could use venture debt. That was our case. But generally speaking, in last 6 years since this company got started, since we started our journey, the ecosystem in our part of the world has come a long ways, both for venture capital as well as early stage seed and angel investments. So depending on your life cycle of the company, I think now you have tons of vehicles or options, everything from angel and seed investment to venture capital to get you started. But generally speaking, ideally what you want to do is you want to build a proof of concept for your product or for your service through your friends and family and personal capital. Get the product to a point where you have a tangible proof of concept, and then you start looking for seeds or angel investment. And once you have a product in the market, you have some revenue to show for it. That's when I would go for your first venture capital or your Series A.
That's extremely helpful for everyone who's in the room, who's coming from the borrowing side. I am looking at all of the questions that they keep pouring in. I am sorry that we're not going to be able to address them all, but what we will do is we will share with these speakers the questions, and hopefully some of them can be addressed after the session directly to those asking them. So I do encourage you to keep bringing those questions in. We do have a question from a repeat alumnus of the AIM Summit, Rabi Khoury, who's made a statement but also asked a question. He says that for venture debt to succeed, 2 things have to happen. The cost needs to go down, 1, and we need to attract Islamic investors, which could bring more capital to bear and help bring down that cost. And he's asked for ideas around Islamic venture debt products. I'd like to actually start with James on the catalyst side. Is this an area that you looked at? And then on the Islamic side, is that something that you think is attractive from the institutional investor side? And then I'd like to go to Mirza with your reaction to his comments and any ideas that you may have around Islamic venture debt products. But James, if I could start with you.
Sure, and I'll keep it pretty short. I think that the ADGM needs to stick to its strengths and attract asset managers and finance companies in areas that make sense. And clearly Islamic finance should be one of those. I'm still proud to be from London and still love London and still see London as a home. But as I look at it now, London is still really the home of Islamic finance and has most of the assets, most of the products and most of the services coming out of there. And I think as ADGM looks to grow and attract banks, insurance and fund managers, offering Islamic finance products, the ADGM's got a real chance to attract some of that. And so it's something that we need to look more closely at, and something we're trying to support in our future allocations as we go forward.
I mean, I'm not the Islamic expert at Ruya. My partner is. But I would say, look, there is a fair bit of liquidity in the Islamic marketplace. So I think I would definitely agree that, you know, if we can bring that liquidity into this marketplace and you know, help companies grow, you know, fantastic. I think that's a great idea. I think some of the challenges would be that, at least in my concept of Islamic finance, there needs to be some sort of hard asset behind it. So it's backed against certain assets or based on certain assets. So Islamic finance, in my experience, tends to work better where companies have, you know, some of these hard assets around it. So some of these sale leaseback type transactions and whatnot can be easily structured. But I'm sure, you know, if you give it to a couple of creative people, they will be able to create Islamic structures around the kind of assets that more, you know, venture capital backed companies tend to have, which is like more receivables, inventory, that kind of stuff, as opposed to the larger, harder assets. In terms of the comment I think made about the cost of that, you know, again, look, it's one must consider two things. It's not just about the person who invests and the investors behind them. And it's not just about the person who receives the financing, right? You have to get the balance right. So whereas I would agree that for the people raising the capital for venture debt to succeed, the cost of capital must go down. Well, yes, obviously that would be the case. But then at a certain inflection point, less and less people will be interested in that. So the supply of capital going into providing venture debt will simply go down. So I think if things are held in reasonable balance, everybody wins, and that's beneficial for everybody. It's beneficial for the company, it's beneficial for the investor, it would be beneficial for ADGM and whatnot, and that would be the perfect solution. What that number is, what that cost of capital number is, obviously that's going to change from cycle to cycle, business to business, risk profile to risk profile.
So we are just about out of time, but I would like to close by asking you each to kind of look into your crystal ball, if it were, and saying, you know, what you think is the future landscape of the private credit market in the region. You know, again, of course, casting your perspective as the private credit you know, manager, we have an investor, we have a borrower. So maybe I can start with Mirza, then Maaz, and then James to finish off before closing us out.
Extremely positive.
Extremely positive. James, what's your outlook on the sector in the region?
Yeah, continued growth, continued disintermediation of the banking sector, continued growth of shadow banking, changes in regulation of how these products are viewed, more growth in the tech side of private credit, and more growth in some of these more bespoke solutions as more structured products come into the market. But overall, very, very bullish on the opportunities.
So, you know, for the space that I have experience in, which is the high-tech sector, I would say in the last 6 years, we've seen a tremendous success in the sector overall, in the entire value chain. So starting from, you know, we were saying how seed investments and VC capital has flown into the region, but then you've also had some major successful exits that have provided liquidity to the local investors, you know, Kareem and Soup being, you know, two flagship examples. So with this entire sector coming off of age, it's only natural that private debt and venture debt become instruments that are highly in demand as more and more companies come off age and are ready for this venture debt in the coming years. So I agree with Mirza, highly optimistic.
Excellent. Well, thank you so much for each of you participating in the session. I think it's been highly informative. I think it's been informative. Clearly, we have a good balance of investors, companies that are interested in the space, We have a ton of audience engagement. For everyone, again, in the audience whose questions I didn't get to address, I'm going to share that with the speakers along with your details, so you can potentially be following up with them after the session. Again, if you joined us on YouTube, please like the video and subscribe to the YouTube channel now. There will be upcoming AIM Summit webinars in the series, so stay tuned for announcements on those, and save the date for AIM Summit London edition. It's going to be taking place on the 23rd and 24th of May. Again, thank you all so much for joining, and thank you so much for Catalyst Partners and Ruya Partners for partnering on this session.